Hello, everyone. My name is Matt Fettig. I am the Chief Investment Officer of the San Diego Foundation and want to share with you our fourth quarter investment performance results and review the full calendar 2021 year as a whole. Before we get started, I want to talk a little bit about the current macroeconomic environment. Things have obviously changed as we have gone into the new year 2022, with markets witnessing a great deal of volatility. There are a few trends going on that I think are worth noting. The first is interest rates. Interest rates are going up. Why are interest rates going up? We have inflation in this country, and it is obviously here to stay. We don't know how long. But the typical way in which the Federal Reserve combats inflation is to increase short-term interest rates. Furthermore, this time around, they are also in the process of ending quantitative easing, the purchase of bonds in the open market by the Federal Reserve. All in all, higher interest rates are bad for bonds. Bond prices tend to have an inverse relationship with interest rates. So as interest rates go up, bond prices go down. Another interesting trend, value versus growth. Remember, there are two primary styles of investing. One is growth investing, looking for companies that are significantly growing their earnings or revenue over time. And another is value investing, buying stocks that perhaps are cheap now, and there's some reason why they may appreciate going forward. For several years, we have had growth stocks in favor, and it's really been led by a handful of technology stocks. You've heard the acronym FANG, standing for many of those large technology-oriented stocks that have appreciated significantly. As interest rates go up, and valuations are high in that technology world, we are starting to see some rotation into value-oriented stocks. In fact, we've been seeing it for the last 5 quarters off and on. But the big question we're asking is now the time for value stocks? And if it is, that should be pretty favorable to our investment strategy. And finally, these external shocks that we're seeing. Today, there is news in the press about the situation in the Ukraine and the possibility of a Russian invasion. Obviously, when you have these shocks, these kind of external shocks to the market, it causes a great deal of uncertainty. And with uncertainty breeds volatility. Now, reflecting back on the fourth quarter in 2021, the world was a very different place. We had a great deal of economic stimulus at our backs. Asset prices appreciated significantly throughout the course of the year. In all, it was a very, very good environment for risk taking. So let's start by looking at results for the endowment portfolio. At the end of the year, the endowment portfolio had over $813 million invested in it. And you can see the returns in the blue bars on the right-hand side for the endowment versus its policy index. Remember, a policy index is essentially an index of indexes that represent the different exposures you see in the pie chart on the left. And what you see here is the endowment had a very, very good quarter, up 4.6%, and a very good year, up 17.8%, outpacing its policy index really over all time periods. And this good recent performance has helped bolster the longer term numbers as well, if you look at the 3-year, the 5-year number, et cetera. So very, very good returns here from the endowment. So what drove these returns? For many quarters and a few years now, we've been talking about the ability to invest in less liquid or illiquid asset classes in an endowment because an endowment has a perpetual time horizon. It can absorb illiquidity to a certain extent. And so we have spent years building out our exposure to areas like private credit. private real estate, private equity. And I can tell you that those areas of the portfolio were the big drivers of performance for both the fourth quarter and the calendar year of 2021. So much so that we witnessed well over 50% returns coming from our private credit and private equity portfolio combined, which drastically outpaced the index for such investments. We witnessed for the first time in some time negative performance from our fixed income or our bond managers. We have had this backdrop of declining interest rates, low levels of inflation in the US for tens of years now. And it's interesting to see if we are indeed at an inflection point where the strong returns we've received from bonds become more of a headwind than the tailwind they've been for the last several years. And finally, the portfolio underperformed a bit in the global equity section of the portfolio due to exposure to stocks outside of the United States. Why do we have exposure? Well, we live in a global world. There are many companies out there that are based outside of the US. And indeed, as we've entered this volatile period in a month like January of 2022, you saw US markets decline the most, and non-US stocks actually protect capital to a greater extent. So that's why we have those stocks, and that's why we'll continue to hold a diversified portfolio of global stocks. Let's go to the next slide and look at the long-term portfolio. The long-term portfolio had a difficult quarter, up 2.7%, trailing its policy index by almost a full point. For the one-year period, it was up 11.6%, and you can see a strong result for the three-year period. The first thing I will say is we do have early indications of results from January of 2022, and we have made up that full point of underperformance from the fourth quarter. So that is good news. Comments here, there weren't really segments of the portfolio that significantly outperformed for the quarter of the year. But once again, that non-US equity component or non-US stocks within the global equity sleeve caused some underperformance. That said, again, in January of 22, it was one of the stronger areas of outperformance for the portfolio. The other area worth noting, again, is fixed income. This portfolio has 18.7% in bonds, and once again, for the year, produced a negative rate of return. The medium-term portfolio. The medium-term portfolio is comprised of about 30% in stocks and 70% in short to intermediate term bonds, with a small piece in cash. You can see for the quarter, it slightly underperformed its policy index, and for the year, also slightly underperformed, largely, again, driven by these negative returns that we've witnessed in bond land. The equity portfolio performed well overall and is thoroughly diversified across both US and non-US stocks, as I mentioned before. But in a period of rising interest rates, it is going to be more difficult for this portfolio to generate the type of returns perhaps that you see over the three-year number, 9.4%. I think that is a very difficult bogey to beat going forward, and it is certainly not what we are projecting going forward in an environment where interest rates are likely to be on the rise. Next, we have our intermediate term portfolio. And remember, this portfolio was constructed at the beginning of 2021. It was meant to be an alternative to either the medium term portfolio that had stocks in it. This portfolio does not have any stocks in it, or an alternative to the short-term portfolio, which is essentially invested entirely in money market funds. So this intermediate term portfolio is invested in short and intermediate term fixed income or bonds. And this gives you a pretty good picture of what I've already been talking about. What happened throughout the calendar year of 2021? Well, we had interest rates start to rise. We had negative results from our bond managers. And as a result, you can see this portfolio was slightly down for the quarter and down about 1 point for the 1 year period. And then finally, our short-term portfolio. Remember, this is invested entirely in money market funds. Money market funds are highly correlated to short-term interest rates. And at least until March of 2022, when the Fed may raise short-term interest rates, the yield has been zero. Short-term rates have been at zero. Now, as we do have interest rate rises in the US driven by the Federal Reserve, there's likely to be some yield coming back into this portfolio. But remember, it may take several interest rate hikes before we start to generate any yield of significance. So let's switch gears a little bit to our sustainable portfolios. We first have the Sustainable Endowment Portfolio, launched 2 years ago, now up to $9.7 million in assets. It consists of two managers, a global equity manager and a domestic bond manager. And you can see the results have been good here, up 5.3% for the fourth quarter, up 13.5% for the 1 year period. Results here were driven by both managers. The global manager runs with a growth style to its investing. Growth stocks did well last year, as I mentioned. And the particular bond manager that we selected for this portfolio, while negative for the calendar year, was actually able to do better than its index. Remember, as we've entered this new year of 2022, we are seeing names like energy companies that are up dramatically for the year. This portfolio divests from fossil fuels and as such will not have those names. So it may be a little bit more difficult to duplicate these strong results that we've had in the sustainable portfolio on a go-forward basis. And if we flip the page, the Sustainable Non-Endowment up to 17.4 million, also started 2 years ago, and really positioned exactly the same as the Sustainable Endowment Portfolio. The same comments that I made stand. So that concludes our fourth quarter and calendar year 21 investment performance review. And thank you for listening.